Welcome back to Stock Spotlight. I'm your host, Michael. If you've listened to this podcast for a while, you know we usually spend our time analyzing businesses, discussing valuation, and determining whether a company is attractive at today's price. But today's episode is a little different. I want to talk about something I believe has a bigger impact on long-term investing success than your next stock pick, and that is your savings rate. Before you can compound capital, you first have to create it. Your investing results come down to two variables: how much capital you deploy and how well that capital compounds. Most investors spend nearly all of their time trying to improve the second while overlooking the first. In today's episode, we'll be talking about why the most important financial KPI is your savings rate. Let's get started. One thing I love about investing is that great businesses focus on the operating metrics they can control before they worry about the stock price. As investors, we spend far more time discussing revenue growth, margins, free cash flow, and capital allocation than we do debating where a stock might trade next week. I think we should approach our personal finances the same way. Our personal finances have their own set of operating metrics. Income is our revenue, expenses are our operating cost, savings are our free cash flow, and investments are our capital allocation. That simple mindset shift completely changed how I think about money. Instead of asking, did I stay on budget this month? I now also ask, how much capital did I create that can now compound the next 10, 20, or 30 years? And here's another reason I like this framework. It focuses your attention on what you can actually control. I don't control what the S&P 500 returns next year, and I don't control interest rates. I don't control recessions or geopolitical events either. But I do have influence over how much I earn, how much I spend, and how much capital I consistently invest. That's a much healthier place to focus my energy. I also think it's helpful to think of your savings rate as a trend rather than a target. Maybe you're saving 15% of your after-tax income today. Could you get that to 18% next year, then 20% the year after? Those small improvements compound just like investment returns. One concept I don't hear discussed very often is your marginal savings rate. Imagine you receive a $10,000 after-tax raise. If you immediately spend all of the $10K, your marginal savings rate is 0%. If you invest $8K and spend $2K, your marginal savings rate is 80%. To me, that's one of the best indicators of whether someone is quietly building wealth over time or simply allowing lifestyle inflation to absorb every raise. Now, here's some more math for you. Suppose you invest $10K annually for 30 years at 8%. You finish with roughly $1.13 million. Now imagine you become a slightly better investor and increase your annual return to 10%. You'd finish with roughly $1.64 million. Let's keep returns at 8%, but instead double your annual investment from $10,000 to $20,000. Here you'd finish with roughly $2.27 million. Investment returns absolutely matter, but this example highlights something I think many investors underestimate. Consistently creating more capital to invest can be just as powerful as earning somewhat higher returns. Next, let's compare two investors over the same 30-year period. For simplicity, let's assume they both earn $100,000 per year after taxes. Investor A saves 10% of their income, or about $10,000 per year, and earns an outstanding 12% annual return for the next 30 years. Investor B saves 30% of their income, or roughly $30,000 per year, but earns a more modest 8% annual return. Most people instinctively assume investor A wins because they're the better stock picker, but the math tells a different story. After 30 years, investor A finishes with roughly $2.4 million, while investor B finishes with roughly $3.4 million. Even though investor B earned a lower return, they accumulated about $1 million more of wealth because they consistently created and invested far more capital. That's the power of a higher savings rate. If you've listened to Stock Spotlight for a while, you know I love dashboards, visuals, and numbers. Whether I'm evaluating a business or my own portfolio, I find that a handful of well-chosen KPIs can tell you far more than looking at your account balance every day. If I were building a simple personal capital allocation dashboard, I'd start with just 4 metrics. That first metric is your savings rate. This is the foundation. Now, I define this as after-tax income minus spending divided by after-tax income. In other words, what percentage of every after-tax dollar are you keeping instead of spending? To me, this is the single most important financial KPI because every future investment starts with a dollar that wasn't spent. Personally, I wouldn't obsess over hitting a specific number overnight. Instead, I'd focus on improving it gradually over time. The second metric is your investment rate, and I define this as annual investments divided by after tax income. This is different from your savings rate. You might save 30% of your income, but if half of that sits in a checking account indefinitely, it isn't really compounding. Your investment rate measures how much of your income is actually being deployed into productive assets, whether that's stocks, ETFs, bonds, real estate, or another long term investment. It's a measure of how effectively you're putting your capital to work. The third KPI is expense coverage. I calculate it as investable assets divided by annual living expenses. By investable assets, I mean assets that could realistically be used to fund your lifestyle if needed. For most people, that includes brokerage accounts, retirement accounts, cash, and other liquid investments. I generally wouldn't include your primary residence or personal belongings since those aren't typically used to generate retirement income. Expense coverage tells me how many years of my current lifestyle my investment portfolio could support before considering any future investment returns. I actually find this more meaningful than simply tracking my net worth. My portfolio size doesn't tell me much by itself, but knowing my portfolio could theoretically cover 10 years of expenses, now that's a metric I immediately understand. The final KPI is financial runway. I calculate it as cash and cash equivalents divided by monthly living expenses. This tells me how many months I could comfortably operate if my income suddenly stopped tomorrow. Cash isn't always the highest return asset, but it provides something that's incredibly valuable, and that's flexibility. Having an adequate runway means you're less likely to panic during a market downturn or be forced to sell investments at the worst possible time. Over the long run, I think consistently improving these controllable metrics is likely to have a much bigger impact on your financial future than checking your brokerage account every afternoon. In closing, great investing starts long before you buy your first stock. It starts with creating capital. Before researching your next investment idea, spend a few minutes reviewing your own financial KPIs. The stock market can only compound the money you actually invest. Thanks for listening to Stock Spotlight. Next episode, I'll be chatting with Shivam, how the market is misreading Melly, and to talk about his recent trip to Brazil to pitch the company. Until then, keep your process sharp, your standards high, and your portfolio intentional.